Welcome, everyone, to the ESG Decoded podcast. I'm your host, Amanda Hsieh, today. I'm delighted to have Dr. Carolyn Kousky with me. She's the Associate Vice President for Economics and Policy at an Environmental Defense Fund. Previously, she was the Executive Director of the Wharton Risk Management and Decision Processes Center at the University of Pennsylvania. Dr. Kousky is also a University Fellow at the Resources for the Future and a non-resident scholar at the Insurance Information Institute. She's a Vice Chair of the California Climate Insurance Working Group, and her newest book is Understanding Disaster Insurance, New Tools for a More Resilient Future. I'm really excited to be talking to Carolyn today. I think in the light of this summer with various hurricanes and wildfires across not only the US, but also the world, I think understanding what's happening in disaster insurance in light of climate change, in light of understanding climate risk and perhaps innovation that's happening in the industry as well. So thank you so much for being on our podcast.
Yeah, thank you so much for the invitation. I'm really happy to be here chatting with you today.
Carolyn, will you tell us a little bit more about yourself, adding some color? Obviously, you've been working and studying in the insurance industry for a very long time, but tell us a little bit about your work at EDF nowadays.
Yeah, thanks. I'm on the economics research team at EDF. So we're a team within the organization that does research and policy analysis in order to support the objectives and priorities of the organization. As you said, I've been thinking about disasters and our response to them, particularly questions of financing and insurance for quite a while now, back to when I was getting my PhD and I was looking at Hurricane Katrina, which actually hit during my studies and got me interested in our recovery process and how we can improve it. And like you said, now insurance has become, ever more pressing with the just escalation of climate-related disasters.
And I'm really happy to have you on the podcast because, you read in the newspaper headlines, things about insurance, whether it's insurers pulling out of Florida or, how many, millions, billions of dollars of losses. But it's nice to have someone like you could really come on the show and really kind of unpack it all and explain what's really happening. And also like, how is the insurance industry also adapting as well? So let me just turn it over to you. What are you seeing?
Yeah, we are seeing growing stress in certain disaster insurance markets, places around the country where the risk is escalating. At base, this is a challenge of growing risk and how we manage growing risk. Disasters have always been difficult for the insurance industry, and that's maybe some important background to start with. Insurance works by pooling different risks together. If you think about a bunch of people getting together, putting a little bit of money in the pot, something bad happens to one of them, they get to take the payout. And that's sort of the basics in a really rough way of how insurance works. Unfortunately, with disasters, what you have is that everybody's trying to access the pot at the same time, right? And that is a lot more difficult for insurance to handle. So if you think about formalizing this in a traditional insurance company, they're going to see with most lines of insurance, like automobile accidents, every year the amount of claims they pay is pretty steady. It's different people getting in car accidents, but they don't see wild swings in the amount that they're paying out for auto insurance, which makes it easier for them to price and manage. If you think about something like severe flooding or wildfires or hurricanes, you have lots of years with very few losses, and then you might see these extreme losses. And in order to pay those claims without going bankrupt, insurance companies have to have access to sufficient capital. They can do that through purchasing their own insurance, which is reinsurance. They have their own version of savings, right? They can make use of other types of financial instruments, but all of those cost money. They're not free, and that cost gets passed down to the policyholder. So that makes disaster insurance typically more expensive than non-disaster insurance. And what we're seeing now is sort of an extreme in some markets where it's very difficult to diversify that risk more. It's driving up prices to sort of a breaking point where insurers can't offer the coverage, certainly at a price point that people are able to afford.
When I think of TCFD, the Task Force on Climate-Related Financial Disclosures, that's a task force that was assembled by the G20 finance ministers for folks that are not familiar with it. And the original remit was to come up with guidelines of how can we increase transparency on climate risk so that the financial sector can price it into the market. And financial sector meaning investors on the equity side, lenders and underwriters on the debt side, and also insurance products, as we're talking about today. So I'm the thought in my head is, are we able to price in these climate risk appropriately? Is this what we're seeing, this natural kind of, the market's working essentially?
That's a really excellent question. And theoretically, insurance should be a really good tool to send climate risk information into the markets. They do really sophisticated assessments of the physical risks of climate and how those might be impacting their policyholders. And so the cost of insurance is often very tightly tied to the risk. The one challenge is that insurance are tend to be 1 year policies. They're annual policies. And so insurers are pricing for this year's risk and typically only this year's risk. And so it's actually not a good signal to be sending information on how risk is changing over time. And so what we're seeing be a difficulty in the markets right now is that the prices are reflecting accumulation of risk to this point, and that's growing. And so we're seeing higher prices, but there's still not good mechanisms for letting local governments, developers, businesses, individuals know when you're moving into a new location, how are those risks going to change over your lifetime in that structure? And what does that mean for the cost of occupancy in terms of increasing insurance prices? And so I think insurance is getting partway there to send that information to markets, but not as far as we need to really be fully pricing changing risk.
I'm hearing that's kind of an innovation that's needed, but what else are you seeing in insurance industries as far as innovation wise that is helping to adapt to climate change?
Yeah, we're seeing some exploration of new types of insurance products to help fill current gaps in financial recovery. We know that disasters create wide-ranging costs on households and on businesses. Some of those costs are pretty well captured in existing insurance products, things like property damage and our standard homeowners policies. But we also see that some types of losses are not well covered, things like lost income or business interruption. We also see challenges with certain populations not being able to afford insurance, and yet they're often the ones that need it the most, whether it's low-income households or micro enterprises. These are the types of policyholders that benefit the most because they don't have other sources of funding for recovery, and yet they're the ones that really struggle to be able to pay those premiums. So we're seeing lots of kind of gaps in insurance being able to really be a true financial safety net after disaster. And in response to that, several types of innovations are being explored. One that we've been spending some time thinking about is something called parametric insurance. This is different from your standard insurance in that it gives the policyholder a predefined amount of money based on some measurement of the disaster itself. So think wind speeds exceed some threshold so many miles from your home, you get a set payment. This offers a lot more flexibility to the policyholder because the dollars are no longer tied to exactly compensating for property loss. So you can use it for other types of expenses that are non-property damage. It can also be given much more quickly because you don't need a time-consuming and contentious loss adjustment process. You can just get the dollars as soon as you measure wind speed. So it's really great for when you need funds quickly. We're also seeing other models like how can we embed disaster insurance, either sort of tied to other products to make sure there's more widespread coverage, or have communities or community organizations or local governments offer more widespread coverage. So are there other different types of models that can be harnessed in order to make sure everyone gets that financial protection? So these are exciting, but early days for all of them.
Are we seeing this parametric type of insurance being applied to other types of insurance, not just property or disaster insurance?
Yeah, parametric insurance has actually been around for quite some time. It's been used in the commercial market, I think, for quite a while now. So things like maybe a hotel on the Florida coast purchases a parametric policy to cover the possibility that a hurricane comes close, doesn't actually damage their facilities, so they don't need their property coverage, but scares away the tourists, and so they have lost revenue. So you can use it for that type of loss. It's also been sort of the way that microinsurance has been structured. So microinsurance are smaller payouts, smaller premium policies targeted particularly to low-income populations. And microinsurance pilots and full programs have been rolled out all across the global south and many different countries. And they've been used, to your point, not just for property losses, but for life insurance, health insurance, crop insurance, livestock insurance. So a whole bunch of different types of risks that people face where they need those sort of fast and flexible dollars.
And then for the second type of innovation you were talking about, is there a city or municipality that if people are interested in understanding that better, that they could look towards to see what they're doing?
Well, this is all really new, actually. So there's very few examples actually on the ground, at least in the US so far. I was part of an interesting pilot of this concept in New York City, where a NGO, the Center for New York City Neighborhoods, has now purchased a parametric product tied to rainfall-related flooding. And if that policy triggers, they'll use the funds to make essentially emergency cash grants to households in need. So this is one of those types of different models where the insurance is actually used to help finance an assistance program that would be run by an NGO. So that pilot is not even a year old yet, so we're seeing how it's going. But there are other communities around the country that are starting to think about and explore this solution. We are seeing too in the state of California interest by the state legislature in helping support some of these pilots to get them off the ground. So that's really exciting because we need to start testing and learning by doing and pull out the insights that you can really only get by just trying to make it work.
Exactly. At Climeco, we're big proponents of market-based systems, trying to understand what the market kind of demand and supply for different things are, and using those signals then to continue to adjust and tweak and optimize. But
Exactly.
it's really interesting to hear about these kind of pilots starting to really see where this could go. I was thinking also, kind of two other sides of insurance that I wonder if you want to talk about. One is reinsurance, which I think is really interesting. That's the insurance for the insurance companies. That's one side. The other side I think about also is that insurance companies are also managing their portfolios of what they're putting their money in, or their policyholders' money in, so that it is around, right? When they need it. Are you seeing anything worth noting in those two markets?
Yeah, let's start with the investments. Insurers are large holders of capital for exactly the reason you talked about. They have to hold on to some of that so that it's immediately available to pay claims when needed. And there's actually regulatory requirements around how much capital insurers hold in order to kind of lower that risk that they go insolvent. So they do have a lot of funds. And so there has been growing pressure on insurance companies to take a green lens to those investments and a climate lens to those investments, and make sure that they're not, say, investing in sectors that have really high, greenhouse gas emissions and that type of thing. So that's, really important. The kind of challenge with insurers as investors is that they hold a lot of their funds in, a lot of their dollars in not equities, but in bonds. And so it's a little bit of a different conversation about how you can focus those investments on, greener tech when you're not actually a large holder of equities. But it is a conversation that's ongoing. And I think it's one piece of sort of the suite of approaches that insurers can harness to help support the energy transition. So we tend to think of insurance as being about the physical impact side, right? Helping with the escalating climate extremes, but insurers also have a role to play in helping decarbonize our economy. And so part of that's thinking about their investments, but it also includes things like ensuring this, new technology that might be really risky. We don't know. We don't have a lot of history with it. And so insurers can help with those risk assessments and making coverage available to new green tech. They can also do more in the rebuilding process to incorporate energy efficiency and decarbonization into rebuilding. Say your car is destroyed. Well, that might be a good time to get a little bit of extra money to switch to an electric vehicle. Or you're rebuilding. Maybe that's a great time to think about putting solar on your roof. And so insurers could play a role in providing consumers information on how to do those things and a little bit of extra funding in the rebuilding process as well. So there's a number of different tools they have to help with both sides of the climate coin.
I love that. Other question I wanted to ask you is I know that some states are starting to regulate climate disclosures for insurance companies. One that comes to mind is the New York State insurance regulator, who's basically mandated that insurance companies offering insurance in New York, essentially report on climate risk. What are you seeing as a state of let's say regulation on climate disclosures across maybe the U.S. or um, and probably what I'm hearing is more state by state more than like at a federal level. But what are you saying? You're a more obviously keep much
Yeah.
closer to the pulse of all this.
Yeah, exactly. Insurance in the United States is regulated at a state level. And so different states take different regulatory approaches, which can sometimes be a challenge if you're an insurer that's trying to write policies across the country. And so I think one of the difficulties right now is that states, as you well know, are quite divergent in how they're thinking about climate. And so you have some real climate leaders that are helping to push insurance companies to do more on helping drive the energy transition and make sure that they're there to help with the impact of climate extremes. And then you have other states that are very hostile to any firm engaging in that type of support for climate policy. And so I think that puts insurers in a tough spot that are trying to saddle these different regulatory demands. But you're exactly right that some of the states, New York and California come to mind immediately, are really trying to take a stronger stance on helping figure out where the insurance sector can be a part of the climate solution, right? And so that's a number of the things we talked about today, including disclosure and looking at their investments.
Carolyn, if people want to get a copy of your new book, what's the easiest way for them to get a copy, buy a copy?
Sure, thanks. It was published by Island Press, so you can get it there or places like Amazon.
Okay, wonderful. Well, thank you so much for being on the podcast. A really, I think, fascinating conversation about insurance. I know sometimes people think, "Oh, insurance, how boring." I'm like, no, this is fascinating. This is,
Yeah, well, thank you so much for having me.
mhm.
Yeah,
Thank you.
it was great to talk to you.